So far this year, the S&P 500 has achieved 16 new all-time highs amid steady economic growth, improving inflation, and the ongoing rally in tech stocks. Many other asset classes have also contributed to portfolio gains in this environment. In times like these, long-term investors need to stay diversified and not lose sight of the bigger picture. The underlying economic trends are in favor of lower rates, but recent economic data have sent mixed signals as to the exact timing. Many investors are adjusting their expectations in favor of a first-rate cut in June or July. Gold has reached new highs as investors anticipate rate cuts. In theory, gold can benefit from rate cuts, just as the stock market does. The accompanying chart shows that gold has gained about 35% since its lowest point in 2022, when the Fed was hiking rates rapidly. Interestingly, the S&P 500 has outperformed gold over this period with a gain of 44% with reinvested dividends. Thus, while gold has experienced a strong rally and is hovering near all-time highs, it's important to keep its relative performance in perspective. The choppiness of gold prices over the past few years shows that while it can act as both a hedge during inflationary periods and serve as a store of value, this can reverse quickly as conditions change. Like all asset classes, gold is perhaps most valuable as part of a diversified portfolio rather than as a standalone investment. Bitcoin has jumped sharply for fundamental and technical reasons. Like gold, Bitcoin has also rallied sharply in recent weeks. Some investors believe this might help to boost the price of Bitcoin as new supply becomes increasingly scarce. Similar to gold, long-term investors should view digital assets from the perspective of properly diversified portfolios. Unfortunately, cryptocurrencies have not yet proven to be reliable portfolio diversifiers since they are strongly correlated with the stock market and other risk assets, serving to amplify risk. Careful analysis and risk management are needed to understand the potential risks and expected returns relative to other investments. Many sectors have contributed to S&P 500 returns this year. When it comes to the stock market itself, large-cap tech stocks, including the so-called Magnificent Seven, are still the main focus for many investors. However, many other sectors have contributed to broad market returns this year too. The accompanying chart shows that while the information technology and communication services sectors continue to lead the market, others such as financials, healthcare, and industrials have increasingly performed well. So, while large-cap tech stocks have done well for good reasons, investors should not lose sight of the many other parts of the market that could also benefit from rate cuts, ongoing economic growth, easing inflation, a strong labor market, and more. The bottom line? The choice to invest in gold, Bitcoin, tech stocks, or any other asset should be viewed in the context of a diversified portfolio rather than as a standalone investment. When appropriate, doing so can help to balance other asset classes, creating a smoother ride toward long-term financial goals. Thanks for listening. For additional information, please visit mraadvisory.com.